Welcome to the Vital Tax panel. We are so happy to have Fred back. We haven't had it for a couple of years, and there were some COVID and other issues going on. So welcome. My name is Lori Hagan, and if I don't already have your name and attorney number, that's what I need to process the CLE. So if you're in Zoom, make sure that I get that. You can even put it in the chat part and I'll make sure that I get that. It won't show up in the final video, just so you know, you don't have to worry about that. And I think that's pretty much it. I'll just hand the mic over to, to Fred and let him have
Go have at it. Okay, I just attended NYU's tax conference, and one of the main topics that they started talking about was the Financial Crimes Enforcement Network. And to go back a little bit and explain what's going on here, the Financial Crimes Enforcement Network, FinCEN is the abbreviation for it. They are going to start as of January 1st, 2024, requiring anybody that is a reporting company to identify the beneficial ownership by filing a form with the Financial Crimes Enforcement Network. It's a beneficial ownership information reporting. Now, the beneficial ownership information reporting, if you would go to the FinCEN website, which I have done here, and I'm just going to follow this to get you to understand what is going on here. But what's very important here to understand is this is an extraordinarily complicated process to identify the beneficial owners of companies. Now, this was done as part of the Corporate Transparency Act that was just passed, and there's a history to this. Now, the history to this essentially began when the IRS started requiring foreign banks, et cetera, to identify US taxpayers that had foreign bank accounts. And when they had foreign bank accounts, there were people that were advertising, make sure if you have extra money, millionaires, what have you. There were people in the United States that were establishing or help establishing secret foreign accounts for individuals. And for example, the Swiss banks used to have unidentifiable accounts. In other words, a person would get an account number, but his name wasn't on the account. So his bank account in Switzerland would be unidentifiable. And if he was earning interest or income or whatever, it was not being revealed to the Internal Revenue Service with 1099s, et cetera. So the IRS began a process of trying to find out all this information. Eventually, the Internal Revenue Service won, and virtually all the banks in the world now are providing 1099 information about bank accounts to the IRS. And it happened basically because so many bank accounts were identified. You may be aware of the Panama Papers, where those are the most secret bank accounts in the world. Putin has a bank account there. So eventually that information was leaked, and eventually the Swiss bankers that were not cooperating with the Internal Revenue Service finally did decide to cooperate, because they realized that nothing could remain secret if the Panama Papers identified bank owners, the various powerful individuals' bank account numbers. So what happened after that, after the IRS broke through and got information to of individuals from these foreign banks, Europe started the common reporting system where all the countries, obviously there's numerous countries in Europe, set up this thing called common reporting, where the European banks required anybody that had a bank account to provide the beneficial ownership information of all the banks. In other words, of all their owners, secret owners of these accounts. One of the reasons they did it was to identify terrorists or anybody that was donating money or using bank accounts that were against the law, or they were laundering money, etc. So the European countries collectively set up the common reporting system where they required all the beneficial owners to identify if they had an ownership interest in a bank account. At the one conference I attended, there was a Swiss banker there, and he was complaining or stating a fact, whether it was a complaint or a statement of a fact, but to obtain to open a bank account in one of the Swiss banks with a couple of these trusts, the bank application was 150 pages, because to identify all the beneficial owners of some of these trusts. Now, all the countries in Europe, essentially banded together to establish this common reporting system. I mean, there were a few outlying countries that didn't do it. And you would think that the IRS in the United States would have wanted to get involved with the beneficial ownership identification. They did not, and so the IRS did not provide and did not get involved with Europe when they started the common reporting system, and that was, I don't know, 2018. I don't remember the exact date, but in any event, it was anticipated at that time that at some point in time, the United States would require beneficial ownership information related to bank accounts, as well as now limited liability companies and S corporations, and what are going to be determined, that the term of art here is a reporting company. So in the, with the, and I'm going to go back one step, go back up to here. So you understand the power of the Financial Crimes Enforcement Network. For an individual United States citizen that had a foreign bank account that did not disclose it to the Internal Revenue Service, did not file the bank account registration with the Financial Crimes Network, and if the FinCEN found out about it, the penalty on somebody that had a foreign bank account was immediate and powerful, and it was 50% of whatever was in the bank account. So if somebody had a $20 million in a foreign bank account, his penalty immediately was $10 million. And then there was tax investigation to see if that money was after tax dollars that was placed in there, or if it was unreported income. So you not only had the potential penalty of the 50%, but you also potentially were subject to an audit, and the audit would arguably try to determine if any of that money was in there was taxable, when it was taxable, and if you had back taxes that were owed. So that's why I'm bringing this out as a featured article today, is the Financial Crimes Network and the beneficial ownership, because to determine who is a beneficial owner and whether it should be reported or not, is a significant task, to say the least. So I'm going to go back to the home page here. Okay, the home page asks the basic questions. Essentially, it begins beginning January 1st. Existing companies, for example, everybody I mean, I'm involved with maybe 200, 250 LLCs and S corporations, and I'm not sure what the number is, but arguably almost every one of my 250 clients will be required to register and report to the Financial Crimes Network. So the question becomes, assuming I'm a reporting company from the top, how do I file, whether or not I qualify for exemption, and how do I get a FinCEN ID to do it? So what I'm going to turn to in my outline here, it's several pages back, and you don't have to turn to it because I'm going to go through it, but it talks about the potential penalties for failure to comprehensively file the beneficial owners. Now, beneficial owners, essentially, they talk about if somebody has the ability to direct and has control over an LLC, might be a silent partner, might be somebody that has equitable interests that aren't necessarily part or easily identifiable. All these people that went out to Nevada or what other Wyoming or other countries that secreted LLC information, secreted the owners of LLCs, they are, will have to identify themselves with the Financial Crimes Enforcement Network. Now, just the immediate question pops up: if I have an LLC in Wyoming, and who will see the information? Well, this information is going to be very secure. In other words, nobody that doesn't deserve the introduction to see what's going to be in the filings, but this is going to be the secreted file, but it's going to be handled by the Financial Crimes Enforcement Network, part of the justice system. And it's not going to be that readily available. So the guy in Wyoming that has an LLC, he doesn't really need to worry, unless, of course, he's doing something wrong, and seriously wrong, where the Financial Crimes Network will go after him. So going into the next page of this, which is where some of the questions are. What is beneficial ownership information? It talks about identifying information about the individuals who directly or indirectly control a company. Now, I'm going to go over this. I usually I stand up and walk around and ask questions, which I'll be doing later on, but I'm trying to point out the intensity of what's going on here. The Congress in 2021, they passed the Corporate Transparency Act on a bipartisan basis. Now, anybody that's been following what's going on in the news about politics, there's almost nothing that gets done on a bipartisan basis. And this is a significant, because if it's done on a bipartisan basis, generally that means it's a more serious law, and everybody's going to be required to follow it. The people that will have access to the beneficial ownership information, the federal, state, local, and tribal officials, because the Indian tribes, they are considered, because the tribal organizations, some of the casinos, there's one large one in Florida that's owned by a tribal outfit, is really exempt from a lot of United States law. Well, this isn't. And no, there can be foreign officials also that can have access to the beneficial ownership. one of the key issues that's yet to be decided whether or not banks will have access to the information, because they're, you know, if you have all the banks that have access to it, and we've all seen where the banks information technology has been invaded, and where that information gets free to other people. So it's going to be a serious issue. Now, again, one of the things that's pointed out here, when will this start? Well, nobody can leave here today and file a beneficial ownership information form with FinCEN, because they are not accepting them until January 1st, 2024. So of those 250 LLCs and S corporations that I'm somewhat involved with, every single one of them will have to wait until January 1st, 2024 to have filed, but they must be filed by January 1st, 2025. Now, if a new company is created after January 1st, you know, if I set up a company sometime in February, they'll have 90 calendar days after there is notice of the company's creation. For example, let's assume that I set up a company that's going to be an S corporation, and I assist with the filing of the paperwork where articles of organization or incorporation are filed in Harrisburg, and that is filed February 1st. And the company wanted to do that, and they really want to start July 1st when they're going to issue stock, because sometimes I will establish a company, and then when the stock is issued and it's formally operating, to get an S election, sometimes I would put the July 1st because that's the effective date that the company started, even though it was quote unquote registered in February. Well, here, a reporting company, that same reporting company is created or registered on February 1st. I will only have 90 days to identify who the beneficial owners are. Let's assume that the group that is doing this doesn't identify their beneficial owners until June 30th, you know, one day before July 1st. Well, then we'll have to amend our beneficial ownership, because arguably we will be late with our filing. And again, I'm going to go back to the potential penalty amounts. The civil penalty can be $500 per day. $500 per day for failing to file. Now that's perhaps an extreme case, but the criminal penalty is a $10,000 fine and imprisonment of no more than 2 years, or both. So this is a serious activity, and unfortunately, who ends up having to hold the bag for not informing their clients, or when they inform their clients, they don't, the client ignores the information. And, you know, I say your client's here, and you all start new companies, and I say to you, well, you have to report FinCEN, and here's the application form. It's going to be all done electronically like everything else these days. So you have to electronically file it. Now, unless I spell it out to my client, probably in a writing of some sort, and if somebody fails to do it properly, and the failure isn't too bad, it's when they get penalized is when you know, you hear back, and you hear how it's the attorney's fault that they didn't do it, or the accountant's fault, since Jeff is here. So that is a big deal. And the other part of it is, I recently was involved with an estate matter where the husband and wife were there, and the husband was a second marriage, and the husband, I asked the husband about who the beneficial designations were on his retirement plans. And he said, oh, it's my wife, and so on and so forth. And he wasn't telling me the truth because he didn't want his new wife to know that he hadn't done it yet. He just went through and wanted to appease her, and knowing full well that he was going to do it shortly thereafter. Well, naturally, he passed away before he changed to beneficial ownership, and it created a major headache. And why I'm pointing this out is sometimes clients don't always tell you the truth as an attorney. When I'm talking to somebody about they're going to be setting up a new LLC, and here it's John and Mary are setting it up, but their cousin Ben, who for some reason doesn't want to be part of it, but he is providing them the cash money to set it up, and he's going to be the person in control of this entity. That it can be a serious problem, because if he's a controlling party and he's not identified as a beneficial owner, as attorneys, we're going to have to remove ourselves enough so we don't get caught up into the fact that it was our responsibility to identify the beneficial owners. Because sure than the devil, if there's something comes out and John and Mary are somehow penalized, let's assume it lasts for 6 months at $500 a day, and John and Mary don't identify Ben, their uncle, as the beneficial owner. Who is John and Mary going to identify as the problem? They're going to identify the attorney and hopefully get into the attorney's malpractice insurance. It is a serious matter. And let's go back to the statement I made about the 150-page bank application to open a bank account. I don't know if how much you've noticed over the past couple of years is how much more difficult it is to get one of your clients, set up a new client, set up your business attorney, to have the new company set up. And in the past, I've been able to set up companies. I was able to call one of my friendly bankers. If you don't have a banker, we can get the bank account set up for you right away. They would fax me the information, and it was a relatively easy process. 9/11 happened, and the Bank Secrecy Act happened. And so all of that is tightened things down, but it's going to get much more significant when we go through this. Is there going to be a fee for submitting a beneficial ownership information document? The answer is no, as of right now. Now, one of the things, how do you report it? It will be the beneficial ownership will be reported electronically. The information about the form is going to be posted on the FinCEN. That's why I brought up this web page. You can go to just FinCEN, and the very first headline under FinCEN now is beneficial ownership. One of the things is a reporting company required to use an attorney or a CPA to submit beneficial ownership information. The answer is no, but most companies, they're busy doing whatever work they're doing, and then they'll, don't worry, my accountant will take care of this, my attorney, and the good thing for attorneys is oftentimes anybody that has a medium size, small, not too small, but an active business, they often have a lot of reliance on accountants. So accountants may end up having to carry the water to make sure these documents and this information is filed. The next question that comes up is, what is a reporting company? Okay, what companies have to report this? Well, it gives you two categories, which is pretty nice, I guess. It gives the first type of a company that has to file a report is something called a domestic reporting company. And they include, you can see here, corporations, limited liability companies, and any other entities created by the filing of a document with the Secretary of State or any other office of the United States. Well, one of the questions there that immediately comes up is a trust, a business trust, a reporting company? And there's going to be further regulations about that coming out. And where you get into trouble is sometimes a trust, you have S corporations and they have qualified S corporation trust. I'm going to talk a little bit more about S corporations in a minute, but does the trust have to be invaded to find out who is the beneficial owner of the trust? And is it the trustee? Is it the beneficiaries? The trustee might be the one that is the legal owner of the trust, but if you have a dynasty trust, who owns the life estates at the time that reporting company has to report? The next one is a foreign reporting company. Entities including corporations, limited liability companies formed under the law of a foreign country, but they have registered to do business in the United States by filing a document with the Secretary of State. Now, I'm going to jump a little bit into a foreign reporting company, because oftentimes a foreign company will try to do business in the United States, and they'll purposefully try to avoid any nexus means connection with a state, so that they purposely don't have to file a register to do business in any state. I'm going to be suing a foreign company. Actually, it's a foreign state. It's not really not foreign. It's in a different state, but it's foreign to Pennsylvania. But they're not registered in Pennsylvania, and I'm going to be having to sue them. And even though they're not registered in Pennsylvania, they're registered in the United States. So just as an aside, if it was a foreign company that was registered in Belize or one of the offshore islands that is not trying to do any business here, where do you sue them? And the designation here is to identify the fact whether or not those companies that are formed and registered in Belize or some foreign company, whether or not they have to register in FinCEN. Now, this is a diagram. Under law, you try to figure out under what law was the company created or formed. If it was created under US laws, including the laws of the states and/or Indian tribes, that means it was a United States company. Is the company a corporation? Yes, then it may be a domestic reporting company. The next one down, is it a liability company? If it's yes, it goes to the domestic reporting. And was that company created by the filing of a document with the Secretary of State or any other entity in the United States? Well, then that is a reporting company. potentially. You can see the reporting companies goes down there to the left-hand side there. And the same thing on the other side, if it was created under the law of a foreign country, whether or not it was registered in the United States, if it gets registered in the United States and has sufficient presence in a state, then it may be a reporting company. Now, what about this foreign company that is doing business in the state that should have registered in that state but doesn't register? What's going to happen with them? Well, if they intentionally don't register in the state, will that intentional failure to register will it be deemed to be an intentional avoidance of registering with FinCEN, where it would cost them up to $500 a day for failure to register? So, I mean, I'm just trying to point out some of the, and I hope sometimes you get involved with these things, you don't know if it's interesting to your clients that you're speaking with, but the numerous potential problems with this are really manifest. And if you're a lawyer, you don't want your client looking at you to be involved. And what the bigger law firms are doing, they're doing everything possible, from what I understand, to try to avoid any involvement with being one of the key parties that must register. Now, when you're a lawyer, what I've done in the past is I've incorporated companies. Fred Liechti signed to incorporate. Joe Jones wanted a new company. Can you get it done for me? Yeah, I'll get it done. Joe Jones LLC. And I sign as incorporator, and then I transfer the company to him. And I often have to do that before they get a bank account, because in the operating agreement, it has to identify Joe Jones as the person doing it. But since I'm the one that has incorporated it, and I'm the one that filed that document with the state, who is going to be looked at for not filing these? So remember when I said something about the 200 and 250 companies that I've been involved with? It's clear that I'm going to try to make all my clients very aware that that they have to report this, because if I'm the one that set it up, and my name's still in Harrisburg, you go to the business registration page, and you might find incorporator Fred Liechti. Obviously I've got my own work to do. So the next thing does anybody have any questions about any of this so far?
Is there a maximum on that $500 a day?
The answer is, as of right now, no. And one of the things, just since you asked that, one of the things that's very frustrating to anybody that does tax returns for an S corporation and any information reporting. I don't know how familiar you are. I know Jeff and I have spoken a lot about what to do, because what will happen is you'll have clients that'll come in at the last day you're going to file. When you have to file partnership and S corporation tax returns, it's March 15th. And you can get it extended to September 15th. So if in fact you don't get the extension properly filed, or if you have somebody that comes in September 10th with their information that you can't finish the return, what I have sometimes done is file a miserable return just based on a guesstimate estimate, so that they don't have to pay, what is it, $1,000 a month? It's approximately $1,000 a month. So if in fact, I get these letters that if in fact they didn't file an extension or their new clients, they come in, as I heard that I have until September 15th to file and they didn't file an extension. So what that means is they've got a $6,000 fine looking at them for failure to timely file. This gets back to what's the maximum. And there is a maximum, I think, on the late filing of information returns, but as of yet, it's an open question. And, let's assume they're 1 day late and I'm the attorney that caused them to be 1 day late. 1 day late right now is going to be January 1st, 2025, because anybody that's existing of these 250 companies that I'm involved with, they have from January 1st until December 31st, 2024 to file that. But if they're 1 day late, they file January 1st, 2025. Who's going to pay the $500? I'm not interested in paying $500, nor am I interested in paying 365 times 500. What is that? That's a lot of money.
Single member LLC, they're disregarded for tax purposes. So I have a sole member LLC.
That is a disregarded entity. Based on that, one would think it would be exempt, but I'm not sure that it is. Well, let's assume that it's you'll be my client. What's your first name? Ron? Roy. Okay, Roy's my client, and I file or I get him to sign now and send in the LLC articles of organization. But Uncle Ben is the beneficial owner of your disregarded entity. And he's a secret private partner. Who's the Ben? And the question is, how are they going to get caught? I mean, I'm not trying to, do anything improper here, but Uncle Ben, you've been doing work. Maybe Uncle Ben is somebody that it's your wife's cousin's friend from Venezuela that came into the country, and he's making money and he needs to file a tax return. So people give him 1099 as an independent contractor. So you end up filing the money goes into your bank account. So you file the tax return for him, but he's doing all the roofing work and not you. I mean, I'm trying to say that there's issues there, but if it's a true disregarded sole entity, I don't know, I'm not sure. It doesn't seem to me that it would necessarily be, and you could have a good argument it was exempt. But let's take a look at the exemptions that I have here. Okay, and the reasons why they're exempt, kind of fit in with the disregarded entity, but securities reporting issuer. Now, there's so many securities laws that they have to be identified, and the securities companies, when you call them on the phone, they always tell you, no, I can't do any trades here or anything else over the phone. But the SEC has a watchful eye over them, so they may not have to be identified. A government authority, banks are fairly regulated, credit unions, depositories, money services business. Now that's an interesting one. What qualifies as a money service business? Somebody that's a broker, dealer in securities, securities exchange, other exchange registries. Now, let's throw crypto and Bitcoin in there. I don't know how familiar you guys are with, has anybody had any experience trying to deal with crypto or Bitcoin issues? Seeing no hands back there. I sort of have my screen up here in front of me. I used to walk around and involved with a divorce case now where the husband is actively trading crypto, and they've been separated for 5 years. So I sort of got involved and assisted an attorney, it's in another county, and said, well, here's what you need to do because we don't know what he's doing. Do you know, anybody know how somebody finds out what's in a crypto bank account? With all the, I'm not completely or not even close to being an expert on it, but people have on their phone as a wallet that identifies a key that they can go in to determine what's in their crypto accounts. And one of the issues with estate planning is, let's assume the husband and wife come in and I'm doing estate planning and I have no idea what's in their crypto account. And how's it identified? And how, if you're administering an estate, how do you identify what's going on with it without the wallet of the person that, the wallet meaning the phone that they go on and they identify and get their information. One of the items, what is the main question that's been put on the front page of the tax returns now? The main question that's on the front page of a tax return is, did you invest in, at any time during the year, any crypto or internet currency? You have to answer yes or no. And that, by answering no, if you have done that, that's the same type of offense that was the secret bank accounts in Switzerland. So the IRS is aggressively going after them. Now there are, let's say one of your clients has one of these and he can go and there are companies that will track his wallet, his information, and they'll give you a statement at the end of the year as to all the crypto transactions that you have. But it's not the same reporting company that, Morgan Stanley gives everybody a statement at the end of the year with all the transaction, interest earned, et cetera on there. And if you have a wallet, you can have 10 different crypto accounts and maybe you only report one of them. And what you have to do to report it, you have to contact these people and say that you want a year-end report from them. Anyhow, crypto kind of started 2015, 2016. The IRS didn't catch on to it really till 2019, 2020. And, the question was in the tax return, I think 2 years ago. In the last 2 years, it's been on the front page. So crypto, we've got Uncle Ben's doing nothing but crypto. So the IRS has found some reporting agencies, and there's going to be more activity by the Internal Revenue Service with the reporting. Now, does anybody know what it is to mine crypto? In other words, I can have my own computer, and if I have a very sophisticated computer system now, it's much more sophisticated. I can set up, I'm establishing a crypto coin, and it's sort of an investment in Baskin and Robbins ice. I'm reaching here. Some, obviously Baskins and Robbins, some of these other companies, Permanis, if they had some sort of, we're going to have some special new Permanis going to have 13 extra French fries on the special one, and that's going to raise their crypto price a lot. So and I'm going off a little bit here and I don't want to do that, but the point being that crypto, I talk about the Ben guy that was in the sole member LLC that Ben's in the background doing crypto. I mean, who's the beneficial owner and who has to identify it? When you get into partnership upon partnership, tiered partnerships owned by trust and having trust beneficial owners, that whole thing to open up that bank account, partnership one, that has a partner, another partnership on top of each other and a trust behind that. That's why the bank account opening application was 150 pages, because If you have one partnership and they have a partnership that's an owner of that one of the partners, to try to track down who's in control of that. And if you're, say, one of them has control to sell the whole operation. If everything goes right, it's okay, and I have a 1% interest, but I have authority to cause the whole thing to be liquidated. Is that a beneficial owner? The answer is yes to that, because they have authority to make a major decision with the entity. So I'm not trying to exaggerate too much, but you can see where it can go. And I'm going to go back to my list here. I'm down here to number 10, the investment company. 11, venture capital fund advisor. There are venture capitalists. Often, a lot of them try to be secretive. Insurance companies. One of the ways people would not provide information to the federal government is they would set up a corporation in Belize. The corporation would invest in a partnership, and the partnership would own insurance and have an insurance policy that was cash value insurance policy, and the insurance policy was in Australia or someplace where it was completely unknown. Okay. The insurance companies in America that have to be registered and they're licensed, anybody that's licensed, commodity exchange. Number 15, this is kind of interesting. An accounting firm does not have to be registered. Why? Because accounting firms are, the accountant's name has to be on the bottom of a tax return, number 1. So they're pretty well identified. They're listed. The IRS, you have to file tax returns, you have to have P10s, you have to have special numbers, you have to have CAF numbers. So there's a lot of identification for somebody that's in an accounting firm. I don't see law firms down here. Public utilities, pretty easy. Financial market utility, I'm not sure what that is. Pooled investment vehicle, most of them have to be registered. Tax exempt entities. Now, tax exempt entities, what happens with them is every tax exempt organization, when they file a tax return, it's open for public inspection. As a tax attorney, I end up involved with tax exempt entities, and people don't understand that tax exempt entities are often more expensive. My legal fees sometimes are higher for tax exempt entities because if you just have a corporation, the IRS has access and wants to know every dime that you put in there because you're going to pay tax on it. But a tax exempt entity might be doing the same kind of things that the other business is doing, but they're exempt. And one of the issues there is that they have to file tax returns, and their returns are public. Okay. Entity existing, a tax exempt entity. I'm not sure what that is, to tell you the truth. That might be a support organization. Large operating companies, because they're subject to such SEC regulations. Subsidiaries of exempt entities. Now that gets a little dicey because the subsidiary should be identified by the other ones above, but I'm not sure. I mean, I guess they would just be considered part of it. An inactive entity, which you have an S corporation that hasn't done any work, but if Uncle Ben's with that sole LLC, solely owned LLC that hasn't worked for several years and hasn't had any income activity, but if Uncle Ben's utilizing it, is it truly inactive?
Not entities in liquidation process.
I would think because if they're in the process of liquidation through bankruptcy, they certainly wouldn't be, but somebody that's in,
You're going out of business.
yeah, let's assume that it just so happens that I was involved with a company that liquidated, and to completely dissolve in Pennsylvania, you have to have a tax clearance certificate, and then you get the tax clearance certificate, and then you have to file the liquidation papers. Well, anyhow, the last year the accountant filed for a tax exemption certificate. Whether he got it or not, I don't know, and I never got it because I have the articles of dissolution. And the client just called me today and said, Fred, did you ever file is my entity dissolved? So make that, instead of 250, I now have 251 that I'm arguably have to register. And the answer to that, I think, is no, because they haven't, we could say for 23, it's been inactive. But when you have a liquidation, oftentimes the company will terminate November 3rd and they'll liquidate for 3 years by selling off things. I don't know that, I think they're not inactive, they're just liquidating. So I don't know the answer to that. So
There'll be some more regulations on this. Is this
uh,
an annual filing, by the way?
that's my understanding it's going to be.
Wow.
So that's certainly a possibility. And then everybody, every year, all the accounts in the world are going to do it, when the tax returns are filed. And if somebody doesn't want to use you to file the tax returns, you might think that they're off. But one of the things that if you're the attorney that started it in the beginning or helped start it, that could be an issue. One of the things is, who is responsible inside the organization to file it? So that's something that's been a question. In other words, let's take, you have a partnership with 10 partners. Who bears the responsibility of filing the document? Let's assume the 10 partners, each of them 10%. Well, who's controlling?
Tax matters partner.
There you go. Tax matters partner. But they were, there was discussion about it, and it's not, one of the, I'm going to talk about.
Clarify that, what's the tax matters partner you refer to?
Oh, the tax matters partner, when you have if you're doing tax work and you have a partnership, you have to identify who's the tax matters partner, because if the IRS wants to come out and audit a partnership or deal something with S corporation or tax return, they want to identify one person and somebody has to sign. You got any other comments there?
They don't want to go after 20 partners. They want
Yeah.
to go after one person.
Go ahead.
It's usually identifying the partnership agreement, they're not incorporated.
Yeah, and and I've right now, one of the things in a partnership or LLC, every bank wants an operating agreement. Okay, and in the operating agreement, you have to identify it. And the question is well, let me ask you, this is probably a better question. Somebody starts a company and they've got 4 or 5 people involved with it, they change, people pass away, and then sometimes if they're lucky, their smart kids will come in, the bad kids won't come in and wreck the business. But how accurate do we keep the documents in Harrisburg? And I'm embarrassed to say that I don't hardly do it at all. Okay, is anybody else? I mean, I know some quote unquote business attorneys, and it's almost like making work because I'm, you guys are a business here. Oh, make sure we file and keep our documents organized in Harrisburg. Now, people are looking at that. When somebody wants to get a bank loan, they'll say, well, I looked up your company in Harrisburg to give you a loan, and you're not listed as an officer. Well, I filed these tax returns for the last 10 years as the tax matters partner, 50% owner, or whatever, what have you. I think there may be some more activity there, but people are getting back to the LLCs in Wyoming. People don't want people to know who they are, where they are. I have one client that was running a lot of rental properties, and they went to a seminar and with one of these flip guys that's going to teach you how to flip houses. And the comment was, well, you can buy on the periphery of what is between a good housing market and a bad housing market. So the Mount Oliver real estate company that gets these herds of people that come in and buy 20 units, and they're going to build them and fix them until they get 30 calls in the middle of the night. The commode's broke, the water's this, the water heater's broken, the window's open, or whatever. And then they end up selling them. And I had a client that wanted to sell a couple of his properties, and he sold them to another fellow that has a pretty nice business in the surrounding Pittsburgh area. But where he picks up some of his houses is he'll have a magistrate here, and he'll go down, and he has to evict one of his tenants, and there's somebody next to him that is pulling his hair out. I can't stand owning this houses, and he buys them for $1,000 because, it's the thing, but getting back to sort of my question is, with these people that have these type of entities, who keeps up with them? And are we, let's assume that you have a couple people that, how many operating agreements have you amended after you originally set them out? Might be the better example.
Right.
One of the items that I would do is I'd set up a corporation, and if you've ever dealt with the Internal Revenue Service, what will happen is people, the IRS agent will come out, they want all the bank statements and everything, and then they want the corporate minutes. I've sort of advised my clients to almost, if they're a small business, minutes aren't really that important. Okay, because all the minutes will do in an audit is arguably hurt you because they didn't allow you to sign up for this loan or that, whatever, it doesn't matter that, or who was employees and who was hired. If you hire them employees and then give them 1099s, you have that kind of, well, you said they were employees, it's that sort of thing. Where I'm, really adamant about strong minutes with a company in the annual meetings is if in fact there's going to be conflicts in the business arrangement. Now, I'm trying to remember, I do some business succession planning, okay, and to have there's Frank's concrete company, and he's got 5 or 6 brothers and etc. And they're going to have that company go down and be in the family for how many generations? Do the kids all want to do concrete or welding or what have you? And one of the big problems is that oftentimes the organizations don't last because the kids want to do something else. In fact, in one of my speeches now, when I'm dealing with somebody that needs to do business succession planning, that's got a pretty decent enterprise going, I tell them there's an organization, and I can't remember the name of it, it's a long name, that it's to be a member of this organization, you have to have a family business that's been in existence for over 200 years. And I think the total number in this organization, there's probably more than this, but they're just part of this group, was like 45. There was one American company and then 40 from around the rest of the world, because the family doesn't deal with it, can't keep the business going because of a wide variety of reasons. And we got into this by asking how, who's a tax matters partner, which might be tax matters partner, I was trying to point out, might not be the controlling partner, they're just the one that's looked to. But then I asked about how many people are keeping up with their documents. And if you if you didn't keep up with your documents, and you have Roy there that looked at your documents and said, well, here's the guy that's in control, and you didn't keep up with your documents when it was really, since I know your name, Roy, you're in trouble. And somebody else is really the controlling partner, in this organization. And if you step in and try to get them to sign based on the operating agreement, have you done any, or you're short-sighting yourself? It just brings some more importance as to how are we going to comply with this law? So anyhow.
One quick question for you about that dissolution you did. Why did they decide to do the dissolution instead of just being inactive?
There were 10 different people, and I often do an out of existence affidavit, okay, because it's easier, because you don't have to wait around to get the tax clearance certificate. And I most clients don't want to spend any extra money on any extra legal fees. It's not necessary, quote unquote, and the complete dissolution, if it's not going to be inactive, you don't have to file a tax return if it's inactive, and et cetera. But
What's the out of existence affidavit?
it's a PPA form that you sign and send it in. And what you're doing is kind of putting the Pennsylvania Department of Revenue on alert that there's not going to be any more things filed. But I've used that, and sometimes they don't accept them, and it's a little dicey. Have you used those?
It's been a while, but
Yeah. So, but getting back to the dissolution, there's a group of people that were all angry. The reason I got involved was I was sort of been a stable person that's been able to deal with complicated messes, and they got me to help. And they want this over, and I don't want my name associated with anything. So some people demand it, and then when you have 5 different people, or sometimes 2, because 2 people can create a conflict, that I don't want to be associated with this person anymore in any way, shape, or form, and I want it dissolved. That's why.
I'm just really concerned I had, and I don't know the answer to this, is when you dissolve that corporation, then you lose that protectorship of the corporation. So
Yeah, well, yeah, it's if you're going out of existence, or if you're going inactive, which was the last one that identified that doesn't have to report. If you are truly inactive, there's not really much that can happen to you, although I've had examples of people will get notices that they haven't paid, file their 940, 941s, and et cetera, so that sometimes you still get crap in the mail, so to speak, where the people are charging you for things for not filing returns. And you, as the attorney or tax person, you end up having to address and deal with those kinds of things.
The other thing it does is it lets the Pennsylvania know what happened to your assets.
Yeah.
If you sold them, they want to know, did you make a profit on the sale when you liquidated? And that's what
what?
when you liquidate, if you sold the asset, they want a piece of the income from it. That's capital gain for their purposes too.
So I was talking about dissolution, which I see is different than liquidation.
Well, dissolution is
You still have to get rid of your assets.
Yeah.
Right, but so if you do a sale, right, you get the sales certificate, you file the clearance certificates, all that stuff. You're done, the assets are done, the transaction's done, as far as I would hope, as far as they're concerned. And then you're just sitting there with a company that's doing nothing, that has no assets.
But what the clearance certificate says is that you're all cut up with your taxes and you're free to go.
Yeah, and you don't owe you don't owe sales tax from
Right.
1919, because there is no statute of limitations in Pennsylvania on taxes, just for your insight. As there is in federal government, there's 3 years to audit unless there's fraud, and if there's fraud, it's 6. If it's, it can get worse. And then the statute of limitations for collections essentially is 10 years, but it can be more than that with the IRS. And
Well, that's a whole different.
yeah,
That
well,
has to
Yeah.
In this day and age.
I'm not sure what that, I don't have an opinion on that one. But getting back to your comment about a dissolution, what I often call, people come in and they'll have issues, and I say, here we will terminate now. We have 20 assets and it takes, 5 years to liquidate, or it ends up in bankruptcy liquidation or some such thing. Anyhow, I'm going to try to get back to this a little bit. Here we have, and I'm not trying to spend all my time on this, but it's here, who has substantial control? Senior officer, president, chief financial officer. And where substantial control comes in often with the IRS is who is responsible to file the payroll taxes and pay it. And I've litigated a bunch of issues there on who is a responsible party to pay payroll taxes. If you are an advisor, I had an advisor in a strip mining company came in and said, well, here I've advised the guy to pay his net pay to his employees so he can make sure he gets work done. And I said, well, by saying that, and he didn't quite advise him that, but he said, go ahead and do what you're doing. He arguably was a responsible party to tell him not to pay payroll taxes to his people. And now that I'm thinking about that, would the advisor, a consultant, have substantial control over an entity? Here you're talking. Oh, hello, Brad. Here we have senior officers, etc. The appointment or removal of authority. This is what we were talking about with the documents that were, whether or not you had it kept up to date with the documents at Harrisburg for all the corporate documents there, or the operating agreements. Important decision makers. This is business decisions, nature, scope of the business, selection of the termination of business lines or ventures, or geographic focus. This is an advisor telling him not to do this. Entry into termination or fulfillment or non-fulfillment of significant contracts. Those are vital decisions. Finance, sale, lease, mortgage, so on and so forth. Finances, compensation schemes, and incentive programs. Now, I mentioned I was going to be suing somebody in a partnership situation. They all invested in, and there are 4 or 5 of them that schemed to defraud somebody else out of the funds, but they were secretly scheming and controlling the finances. Okay. The catch-all here, any other form of substantial control over a business. Okay. And I'm going to, since I've spent enough time on that, I'll just get down here, try to touch on a few other things. What's an ownership interest? Equity stock, pre-organization certificate of subscription, which is what I was doing. Somebody that transfers stock into a trust, capital or profits interest in a partnership. This gets, if you've ever done a partnership litigation, this gets really dicey. I've got one of those right now where a guy gets $45,000 a year as a guaranteed payment because he was the only one that put a capital. He put a building in and everybody else put in other things. So he gets a profits interest. And he has no other control. Convertible interest, where you can convert equity into debt. If you buy an option on a company, so on and so forth. So this is all, gets all pretty dicey, and I'm here you have an unaffiliated company provides a service to a reporting company by manages its day-to-day operations. I have a client that buys other companies that are going to be liquidated, and he sets it up so he does the work to sell the stuff. The original owner, for tax purposes and everything else, and a presence in the state of Texas, they liquidated a company in the state of Texas, and he made sure that he didn't have a physical presence or a nexus with Texas, so he didn't have to file a tax return. He did all his work from Pennsylvania, even though he was calling, and sometimes he was calling, his feet were very close to the Texas phone that he was calling. But he tried to stay out of the way there. But is he a beneficial owner of the reporting company? Is a member of reporting company's board of directors, is he a beneficial owner? Because the board of directors directly or indirectly exercises substantial control. I mean, I'm going on and on. And here we talk about the designated partnership rep, tax partner. Okay. So I think I've done enough here to whet your appetite, but this is it's an area of major concern. And, you know, let's go down, let's talk about the bank or in Switzerland that had 150-page application to open up a bank because they had all these stacked partnership and ownership. Who is going to do the work? Now, when there's a business owner comes into my office and say, well, here's what we need to do, A, B, C, D, and E, and get the beneficial owners. But when you're the guy that's writing the paper, and it doesn't take 5 minutes to identify these 10 people when their names, addresses, it takes you 40 hours. 40 hours at whatever number, $500 an hour or whatever you're charging. Who's going to pay for that? I mean, that's who's going to pay to have you redo all your operating agreements? Nobody wants to pay that. They don't want to pay it when they get started. The only reason they pay you to do an operating agreement is because the banker won't let them open up a bank account unless they have an operating agreement. Go ahead.
Is that 150-page document somewhere we can download to see what they're
Well,
asking?
it's just a bank application, but the bank applications ask for beneficial ownership, and he just, well, let's say to identify the partners, here's 3 pages, but the partner was a partner of the partnership, and it kept going. I've never, it was just that sort of thing. So I don't think it started out as 150 pages, but there will be more and more documents. I mean, it's identifying who's doing what, and a lot of it is quote unquote unnecessary, especially if you talk to the coal miners that I used to know that did everything by a handshake and a bag of cash. And I don't know if you've ever had a bag of cash with $80,000 in it, old money that's been married, but it smells like the devil. So just let me tell you that. And then, I had to carry an $80,000 bag of money into a bank one day, and that was no fun. It's no fun because you think you're going to get, robbed, and if there's 1 penny missing, obviously you're in big trouble. Okay. I'm going to turn here to why Jeff is here. You go through this, and this is the other thing that's happening. It's I should have had numbers. When I printed, I didn't get the numbers on it, but the sunset of the Tax Cuts and Jobs Act. So we're going to shift break at 1:30. Okay, well, okay. How many people are familiar with what's going to happen in January 1st, 2026 with the tax laws? And what's going to happen is the tax laws that were put in place in 2017 that raised the federal estate tax from 5 million to what is up to 22 million or something like that. I mean, 11 million, but they have the option where husband and wife can, the husband dies first, transfers his credit 11 million to the wife, so there's 22 million. I mean, the tax law that was passed in 2017, since it was done by one side of the 51 members and not a complete six, it only lasts 10 years. So as of January 1st, 2026, right there, I always get, will go back to the old law. For example, right now we have a standard deduction for each person. It's 12,500 or whatever. I don't pay attention to numbers, so I just get them close. But the standard deduction is now $12,500, 22,000, 24,000 for a married couple. That's going to go back to 12,000 for a married couple, and all of those taxes that you're limited now to what, $10,000 in real estate taxes as a deduction will go back to the way it was. All the laws go back to the way they were before. Where this is a big time issue is for somebody that does federal estate tax, because right now my clients could give away to their kids $22 million. And by the time that 2026 comes around, it will go back to the old law of, I guess, 10 million. But what that translates into is that I'm going to, somebody, if I have a wealthy client, I'm going to want to do a lot of gifting between now and January 1st, 2026. I'm just going to say 2026 now. So, because if I don't gift that out, I may lose the opportunity to make those gifts. Does everybody understand what I just said? Go ahead.
But that could change based on the election.
Sure.
So, I mean, as of now, that's what's gonna happen, but
Well, here's what'll arguably happen. You know, nobody knew, you know, the election's going to be crazy for a zillion reasons. But one of them is when Biden took over, everybody, well, you're going to raise taxes or do what you want. He didn't. The reason he didn't want to or didn't have to, because he knew about the sunset, because it's not going to be him that does it. It's going to be by operation of law. And then since there's nobody that, I mean, nobody knows what's going to happen. I mean, the Republicans had a heck of a time getting Kevin to be the speaker. Then he's no longer the speaker after 2 months, and now he just resigned yesterday. And the other one that's in there, who knows who's going to be? I mean, they can't. Nobody's getting anything done in Congress, so it's hard to predict what is going to happen anywhere. I mean, even if we're going to have our funding for Ukraine or Israel, or if the government's going to be operating within a couple months now. But anyhow, getting back to this, Jeff is going to be talking somewhat about the tax issues. I'm going to be doing something on the estate part, and we only have, going to have an hour and a half left. Brad here, who just came in, Brad is our retirement actuary that has this. So what we'll do is we'll take a 5-minute water safety break or 10-minute water safety break, and there's coffee and you have refreshments. So the break here is the best break you'll have at any place that you ever have a seminar. So, and then those two will be able to get up and say something. So break time, let's go. I'm going to call you all to order. We got a lot of stuff to do here. See if you can find in your booklet. I wish I made the mistake of, I don't know who the beneficial party was that didn't put page numbers on these pages, but look to the, see if you can find the top of the page, sunset of the Tax Cuts and Jobs Act, because that's what we're going to be talking about. And Jeff's going to be speaking here about the income tax issues. First off, and then we'll proceed from there. So Jeff, have at it.
All right. So Fred led into it by talking about the personal exemptions. The standard deduction went from 13,000 up to 24, and we don't know where it's going to go once it sunsets. We do know that it's scheduled to go back with inflation, but the other thing we don't know is whether or not the child tax credits are going to be coming into effect, whether they're going to go away or not. But with regard to the tax brackets, they're going to be going up probably. They're kept now at 39.6. So the idea is to try to tax, since some of the rates are going to be going back up, you want to pick up income in the current years. So before this happens, capital gains tax, we don't know where that's going to be. We also have the investment tax, which is at 3.8%. So one of the things that we're suggesting is that you convert an IRA in current years to a Roth IRA. Now you're going to pay tax when you do that, but once it's over into the Roth IRA, there's no tax on any additional income that's earned. So
Is there any period of time that once you convert, it has to be a Roth before you start on your own?
It's a 5-year. You have to
it's
wait
5 years. You have to have
Right.
a Roth 5 years.
Just since I'm here to confirm it.
Right.
Okay.
Mhm. Okay. The other thing we're talking about doing is harvesting some of the capital gains that you have. Now, brokers have been doing that as they go because they want to protect their assets. It's been fluctuating all over the place, but as the value goes up, they're harvesting so that you pay tax now and protect any downside to it. So they're moving it over to cash, but they're buying back in. And usually they're going back in at a higher basis. But if you convert now, it's going to save on some taxes as the rates go back up in 2026.
What's going to happen to the capital gains rates?
The rates are, we don't really know what they're going to be. at
I
that
was
point.
gonna say, it
Yeah.
seems like they're lower now, and they're gonna go back up, and it's probably better to sell things now. Is that the strategy?
Right, that's a strategy, especially since you're paying tax on the capital gains. If you have enough income, you're going to pay an additional 3.8% right now. There's that net investment income tax, which is at 3.8, so you're going to pay capital gains, tax on capital gains and dividends there. The other thing is we're talking to people about taking the required minimum distribution out. And now they've raised the age from which you have to start taking it out. It started out at 70.5, then it went to 72 years old, and now it's at 73 years old. Now there's people that turn 73 have until April 15th of the next year to start taking, but when you do that, you have 2 years that you're going to have to take out minimum distributions, because you have to take it out you're deferring from 1 year to the next, and then you have to take that year. Still conceivably at a lower rate. The other thing is the individuals can, transferring the gift tax is going to be going back down. So if you give gifts out now, your exemption is higher. It's you can currently transfer up to around $13 million, and and a married person can give up to $26 million. Where that's going to go, we don't know. But chances are it's going to go back down.
The RMP,
Mhm.
the 10-year rule.
if the decedent had been receiving distributions and dies, okay, is that, you have 10 years, you take it out in the last year, or you take it out, you know, at the same rate as the decedent? I understand there's a difference. If you had the decedent had not been receiving distributions, you can wait till the last year.
You can, right, but if
Is
they,
that definite now?
yeah, it is, by the Secure Act.
So that's correct, when I
That-
said, that
that's-
if it's after, you receive, he or she receive distributions,
That's right.
then you have to take it out.
They have to take it out within 10 years.
I mean, but you have to take it out proratically, or, you know, you can't wait till the last year. You have to take it out, I think it's the same way. That's the
You have to take it out, it's at least, I think it's at least the life expectancy of the deceased, right?
Yeah, and I think you have until,
Right.
it's my understanding, and I could be wrong with this, I don't exactly know the answer, because I look it up every time.
Mhm.
So, yeah, there is a provision where you can wait the entire 10-year period, it has to be taken out within 10 years. And you can't wait for
Well,
that.
that's, I mean,
That's
that's
definitely,
he or she hadn't taken it out.
And if it's a required minimum distribution per year, that's different.
Yeah.
So that's my understanding. We'll talk a little bit more about that since we have an actuary here.
so the idea, the concept is to take income into your possession in current years while the income rates are lower. We know that they're gonna go back up. Well, we think they're gonna go back up. It depends on who actually gets into power. The other thing that's happening is the alternative minimum tax. I don't know if you know what that is, but there was a minimum tax that was placed on what's referred to as tax preference items. And there's a list of them that the IRS gives you that says if you're getting a tax break because of certain deductions, then you have to add that back and pay a minimum tax. And what's been happening, it started out real low and stayed there. So as people were earning more money, that more and more people were creeping into that alternative minimum tax area. So when the Tax Act was put in, they increased the exemption considerably. But it looks like that's going to be going away. So it's going to creep back down. So there's a lot more individuals that will fall into that. And it doesn't have to be that high in order to get stuck with that the alternative minimum tax.
Jeff, have you been done tax returns for your clients and all of a sudden they think they're only gonna pay so much?
Oh,
They
yeah.
get massively surprised with the alternative minimum
Well, it
tax.
used to be more so than now, but the minimum tax has gone away because the threshold is so much higher now. But when that goes back down, it could drop $25,000 down to a lower rate. So it puts you into that minimum tax bracket.
For those of you that don't prepare tax returns out there, that is a punch in the stomach because you're moving along, you think your client's gonna have to pay $50,000 in tax, and all of a sudden it's $80,000 because of the alternative minimum tax, and you feel like a heel trying. What you do is you get the beneficial owner of the tax return to go and tell them that they owe 30% more, 30,000 more tax. It's an awful experience.
And the problem is it's so hard to plan for it because you don't know. A lot of the tax advantages are passed through from partnerships, for example. It's excess depreciation, and you don't know what's going to be coming through on one of these information returns until it comes through. And so you're just stuck, and you have to face the client and tell them, well, we didn't expect to have to pay another $10,000 based on this, but we know that it's going to come back in. We don't know exactly where that threshold is going to be. It's hard to believe that a lot of the politicians are going to be the ones that want to say you're going to be paying more tax and have to face their constituents, when they do that. But, they're gonna have to pay some of the debt that's going on. So again, depends on which side we're looking at. So some of the other things that Fred mentioned also, the SALT deduction, that's the state and local income tax. Right now, everybody is subject to a maximum deduction of $10,000. And that includes all your state and local income taxes and your real estate taxes. But even though you're paying $30,000 in those taxes, you're limited to a deduction of 10. So what's happening with my clients is that the standard deduction is so high that they don't have to worry about that SALT deduction, although they're losing a lot of the benefit of it. But they're doing they're getting the benefit of the standard deduction. In some cases, it makes my life easier, but in other cases, it's still, they've got to pay, they could be paying $50,000 in state and local income taxes and real estate taxes, but they don't get the benefit of that.
It's a doctor that lives in North Hills that's making a couple $1 million and has a, $2 million home, and he pays $60,000, $70,000 in state taxes, and he only gets to deduct 10,000. The person in Florida, this was put in to help the low tax states and to push hard. That's where they kept some money going to the treasury by keeping it higher. The higher state income tax states got burned on that.
Yeah. The other people that got burned were the charitable organizations, because now you can't, if you're taking the standard deduction, you don't get the advantage of the charitable deduction. So people don't feel like they're getting a benefit, they're not contributing as much. So the question is, if they lower that and put that back in, will the charities start getting more? Because, if somebody's in the 30% bracket, it doesn't cost them the full dollar to get advantage of that. The other thing that's, we don't know what's going to happen. It's when the Tax Act was passed, miscellaneous deductions and the casualty losses were eliminated. So if somebody had a fire in their house and didn't get full benefit from the insurance company, it used to be within limits, they could take a deduction for that. Now they can't, but will they reinstate that? We don't know yet. Okay. And as I said, the miscellaneous expenses, for example, the attorney's fees for an individual, tax preparation fees, tax planning fees, they're not deductible at this point, but will they go back in? It's possible. Moving expenses, when somebody took a job in another state, it used to be that they were able to take those moving expenses and deduct it from their income so that they pay less tax. They get a deduction for it. It went away when the Tax Act came in, but there's a chance that it'll come back. And the another item is the home mortgage expenses. They're capped at $1 million for somebody filing, capped on debt of $1 million. That came in with the Tax Act, but it's likely to return and go back to the fact that you can take a deduction for anything that you pay interest on, home interest, and the home equity interest. It looks like it might come back because you can't deduct that.
That same doctor in North Hills has bought a $2 million home that has a $2 million mortgage. He can only take half of his mortgage deductions, lose their state tax. So there are a lot of people that got hammered because of that, and the airline pilots that had tons of miscellaneous business. They were employees and they could take expense there. Well, one thing I want to touch base with you, Jeff, have you ever done a Roth conversion where you try, because one of the things with charitable deductions, they're still a valid deduction, but the problem is you don't have enough of them unless you do pull it all in 1 year. If you're going to do a Roth conversion, and somebody's wealthy enough to do that, one way that they can mitigate the extent of the taxes if they plan all their charitable deductions in 1 year and try to balance the charitable deductions. I mean, it's just an individual that would have that. Or if he would be able to be a business owner and buy a big piece of equipment, we were talking about the bonus depreciation before, so that you could maybe bonus depreciation and charitable deduction to minimize the impact of converting to a Roth.
The problem with lumping them into 1 year is that you only get the benefit over the standard deduction. If you're only gonna put $2,000 to take you over, it will help a little bit, but it doesn't help as much. But we have some clients that want to keep their cash as long as they can. So they'll just take their chances with the standard. The other thing is that you are getting a benefit if your state and local income taxes are low and your charitable is low, you don't have medical expenses. That standard deduction does really help in a lot of cases. But it's the high income taxpayer that gets hurt, the ones that are paying the high real estate taxes and high income taxes, state income taxes.
Well, the issue here, anything else? Are you good there?
No, I'm good.
Okay.
We can talk.
Well, one of the things that, just because I'm trying to move things along here, because I'm keeping an eye on the clock here. The basic issue with the taxes is that it's potentially changing, and you have to keep a sharp eye as to what's going to happen there. What's been a great benefit of having this program every year is we have the benefit of having Brad Barlow with us, who does retirement planning. And what I'd like you to do, and I'm going to introduce Brad, but this is take a look at this sheet of paper here, because what this is a sheet that shows what happens if you have, and I'm just going to start this off for Brad. If you have two dentists that own a practice, on the left-hand side, the dentist owner 1 is 55, dentist owner 2 is 53, and they're both getting $330,000 a year. That's the owner totals of $660,000. Then they have employees, and the different ages. The 45-year-old gets $60,000. The employee 5 is 38, gets $35,000. And if you're planning a retirement plan, and there's a whole slew of different retirement plans here, and Brad's going to be discussing how you can maximize your deduction, because if you put a plan in, most everybody knows that you can't discriminate against high-paid employees versus low-paid employees. And here's a complete graph that shows you what you can do with the sophisticated plans here. And why part of my introduction with Brad is I have a couple people. I had an attorney came to me, said, Fred, you got to do my tax return. He was making $60,000 a year, and he was an older return. He gave somebody a referral, and he got like $400,000 or $500,000. I think $438,000 as a one-time referral fee. He came to me April 13th and said, I got to get my taxes done, but I owe a lot this year. And I said, stop. Here's what we're going to do. And and this is where Brad and I have worked together very effectively. We were able to put in maybe 200, this guy was 73 years old, something like that, which you can't put money into an IRA at the time after 72. And here he was able to have a deduction of $250,000 that we were able to get in, because I extended his tax return, and we got the plan put in place so that he was able to instead of paying $130,000 in tax, he paid, 25,000, and we spread his tax benefits. So he's got a long-range plan here. There's ways to really skin the cat here with retirement. So this is one of the, Brad is one of the most, he looks rather calm and relaxed, which he is most of the time, unless I call him with one of my problems. But this is one of the best presentations you'll hear. And Brad, I hope
Oh, yeah.
Go ahead. And unfortunately, there's a bunch of new things coming down the road too. So.
Yeah. So I guess we'll look at this. Let's look at this handout first. This is the one that Fred was referring to. What I think that my job is, or what I think I can add, where I can add value is if a client wants to save for retirement and all they might have heard about is an IRA. Well, they can do a lot better than IRA, all right? I mean, you can step up the amount of money that you can put away if you put a 401k plan in, for instance. You can step up the amount of money if you could put a SEP in. You can really step up the amount of money that you can put away if you put a defined benefit plan or a cash balance plan in. Now, there's no free lunch, so you have to explain some of the trade-offs to the potential client. But so you can put more money away and you can deduct it from your taxes. But like Fred said, if you have employees, they have to benefit too. So if it's a owner only business, it's a very easy conversation. Those are almost slam dunks. How much do you want to save for retirement? And then what is the best vehicle to make that happen for you? And what are the parameters around putting that plan in? Okay, that's I mean, and I run into, when Fred brings clients, it's a lot of times that's a client profile. But I also have, there are people who do what I do, have a lot of clients like this too, where it's a small professional practice or a small business. And there are people that the business wants to benefit, and they're also rank and file employees. Well, so then the trick is, and this depends on the age and the salaries of the people that are working, how much for different plan types, how much can we put away for the owners versus how much has to go to be put into the plan for the employees. So so that's a little bit harder. Then the owners have to think, okay, so if I'm getting 80 cents on the dollar, is it worth it to me? But maybe I can put a lot more away. So that's where, so that's one of the tensions that in plan design, where you have a business with employees, owners and employees. So if you look at the handout, the column that says traditional profit sharing plans. So profit sharing plans have been around probably since 1920. They've been around a long time. And the spread between what goes in for the owners versus what goes in for the employees is basically just generated by the difference in their pay. So there's not a lot of sophistication there. And if you go back to, I think it was in the early 90s, the IRS capped the compensation that could be considered for qualified plan purposes. So in other words, when these plans were invented, if you had an owner that was making $1 million and you had an employee that was making $10,000, and the plan was everybody gets 10% of pay, the owner was going to get $100,000 contribution and the employee was going to get $1,000. Well, the IRS, someone in Congress didn't like that, and they told the IRS, let's put a cap on what can be considered for qualified plans. So in 2023, that cap is $330,000. All right, so that limits the kind of spread that you can get in terms of benefits for owners versus their employees in this kind of plan for a simple profit sharing plan. The next column shows what's called an integrated profit sharing plan. And it's an integrated in this sense means that the benefits of the plan are calculated based on what the participant's Social Security benefits are going to be. So the way that works in practice is that the formula, instead of being like 10% of pay, it might be 5% of pay up to the taxable wage base and 7% of pay above the taxable wage base. I mean, so in other words, and it's not, you can't just make any, there are guidelines about how the formulas can be designed so that, I mean, in other words, we could say, again, for our example, we could say it could be 0% under the taxable wage base and 20% above. Well, that's not going to fly. So there are rules about how the formula works. And if you put in one of these plans, you can see that, you know, at the bottom, it shows you the percentage that goes to the owners. So, you know, for these demographics, it gave these owners 4% more versus the traditional profit sharing plan.
Well, if I could jump in here one.
Sure.
If you look at the traditional profit sharing plan, the owner totals was he had pay of 600, together they had pay of $660,000. What happens if you're doing some of this, you talk to the owner and they want to maximize what they get and they want to minimize what they give to their employees. I'm trying to be polite when I say that, but that's what happens. So in a traditional profit sharing, the owners were able to put away $132,000, but the employees were able to pay, the owners had to give $53,000 to the employee. In the integrated plan, the owners were still able to put $132,000 in, the same percentage, but the percentage was reduced for the employees because of the Social Security impact, as it were. So the owner only had to pay $44,000 to the employee. So the owners essentially like this because, you know, those are the numbers you're looking between the owner and the employee. So keep that comparison when you follow along with this. Go ahead, Brad.
So in 2000, or I think around 2002, the IRS published some regulations about non-discrimination testing, and it's a bunch of math, and it's one of the more important pieces in doing what I do. And so some smart folks decided that you could design something, a new comparability profit sharing plan. And basically what that does is that it says that it equalizes contributions when you take into account the time between the participant's age and age 65. So what that means, so owners are usually older than their employees. So it says if you give a benefit to someone who's 64 and you give it interest to 65 1 year, you can say that that's the same as giving somebody a benefit or a contribution when they're 20 and giving it 45 years interest. And, you know, if you look at, so in other words, in effect, you give that 20-year-old a much smaller contribution, and the IRS says that's fine, that works. So when you run this, and again, so the plan design depends on the company's demographics, right? So you plug the demographics into the plan design, and this new comparability, you get 91 cents on the dollar goes to the owners, so that's a very good result. Now, 401k plans were added to the code in the late 80s. And just a side note, 401k, the idea of having a company-based solution that allows employees to contribute to a retirement plan is so successful or is so well liked that 401k is actually just 401k has actually been adopted in the tax code of many countries. So it was started in the US. It spread like wildfire. I mean, it was almost an afterthought when I forget the company that put it in, but some company put it in and it caught on like crazy in the US. Other countries saw what was going on. Of course, this took a number of years, liked it a lot, put the same idea in place in their countries. And instead of inventing new, and the 401k is just a section in the code. So I don't know how they, but these plans are called 401k plans in a lot of other countries, right? Because it's an extremely popular idea. Now, if you talk to the guy who invented 401k plans, he would tell you he thinks it's the worst thing that ever happened to retirement plans in the US. Why? Because it shifted the onus for retirement savings from the company to the employee. So when it was invented, it was like a supplemental, hey, companies had defined benefit plans and profit sharing plans where the companies put a lot of money in the place, and we're going to put a 401k in where you can save a little extra for retirement. Well, what happened is companies got rid of their responsibility, and now it's all up, mostly for a lot of people, it's up to their 401k savings. So the guy who I've read interviews with, the guy who kind of came up with that idea, he doesn't think it was a good thing at all. But that's the world we live in. 401k plans are the most popular retirement plan in existence. So if you couple a 401k plan, if you go all the way over to a 401k with a safe harbor new comparability plan, so that means you're allowing your employees to defer their own money, but then there's a profit sharing piece on top of that. And the profit sharing piece is going to be calculated based on the same principles as just the new comparability profit sharing plan. You can get the percentage of dollars to the owner up to 93%. So that was kind of the landscape for a long time. At the same time, there were also defined benefit plans. And defined benefit plans are the defined benefit plan that every taxpayer knows about is Social Security. Social Security is a defined benefit plan. The benefit that we all are going to get from Social Security, hopefully, is calculated based on our average earnings over 35 years and the number of quarters that we earned those W-2s or with FICA earnings over, and some Ben points they call them, and you just plug all this stuff in and it goes through and it spits out a monthly benefit. That's how a traditional defined benefit plan works. I mean, and a lot of companies around here had DB plans. There were individual defined benefit plans for a long time for attorneys. I mean, a lot of professionals had individual defined benefit plans. Well, the IRS decided they didn't like that, and they passed some rules that made those really hard to. If you worked in a partnership, you could have individual plans. Well, the IRS outlawed those by passing some regs that made it really hard to put them in. So now they are the defined benefit plans. New defined benefit plans are the mainly put in for small businesses like this, or individual owners of businesses, or husband and wife owned businesses. I've never heard of a new DB plan going in for a big company. I mean, I'm not saying it's impossible, but I haven't heard of one. They're shutting down. They're not going in. So the advantage of a defined benefit plan is you can put a lot more money away than you can a 401k plan. So that's the big draw. So if you're an owner, you're looking at a 401k plan. Hey, you can put $60,000 away. Okay, well, I'm making $600,000. Can't you do any better than that? Well, if you put a defined benefit plan and you're old enough, you might be able to put $200,000 away. So that's, at the same time, someone in New Jersey invented this idea of a cash balance plan. A cash balance plan is a defined benefit plan that looks like a profit sharing plan. So it has the big contribution ability of a defined benefit plan, but when you communicate the benefit to a participant, they get an annual statement that says, you've got $100,000 this at the end of this year, and it's going to earn 5% interest, and you're going to get a pay credit of 3% of your W-2 added on to that for the years in question. So that's that everybody understands that. It's like looking at a bank account statement, right? Looking at a 401k statement. So defined benefit plans, even for the small market, have gone away. And almost every new plan that goes in is a cash balance plan. I mean, I haven't put a defined benefit plan in for one of my clients in probably 5 years. They're all cash balance plans, all right? So the advantage of a cash balance plan is you get much, much bigger contribution potential versus a 401k plan. So if you look at the last column and you added cash balance plan onto the 401k plan with the new comparability profit sharing component, you can see that the percentage to the owners has gone up, but the big bump up is the total the total dollars that are going to the owners. I mean, we've gone from 73,000 to 270,000. And I can tell you that this is not, I didn't push this example. In other words, a 55-year-old could have, in this scenario, could have put more money away in 2023. So if for the right client, these plans can be a great tax planning tool.
What is that, right? What's the sweet spot for the age?
Well, that's a great question. And I have put plans in for people as young as 21. Okay. So, and the reason's this, there are a couple of other advantages of a cash balance plan over a 401k or profit sharing plan. If for a certain amount of income, you can only put 25% of pay into a profit sharing plan. So in other words, so I had a client that was a young 20-year-old gamer. Like he gamed, like, video gamed for his living. Like somehow, I guess they do he won tournaments, I guess, right? So he was earning a couple $100,000 a year. Well, the most that he could do, the most he could put away in a profit sharing plan, because he was a Schedule C, it was all, he didn't set up an S corp or anything, was he could put his deferral away, and then he could do 25% up to, whatever the comp limit was back then. So he was limited to, I don't know, like $50,000 roughly, I think was the number. With the cash balance plan, we can take into account, he had been doing this for a few years. So for the cash balance plan, you can take into account prior earnings, okay? If you set the plan up right and the client wants to do this, you can increase the benefit going in by taking into account those prior earnings if they are there. So he was young, so it wasn't a huge number, but he was able to put, I think, $80,000 away. And on top of that, you can also have a 401k plan. So in other words, for him, with two plans, he was able to put the 80 away in the cash balance plan, and maybe the 20 or 17,500. I can't remember how long ago it was with the 401k. And then he was able to do a little bit extra in the profit sharing plan. So the numbers go down. But when they get really eye-popping is when your client is in their late 50s and 60s, that people are like, why have I never heard of this before? I don't know. I mean, you have to talk to your advisors. I don't know, because a 65-year-old with enough income can put away over $300,000 in a cash balance plan. So, I mean, it gets better as they get older, right? Or the numbers go up as you get older. But so I would say the sweet spot's probably 55 and up, but I put plans in for people much younger. Depends on the situation. Now there are you know, if you put a cash balance plan in, there are certain things. I have a client who wanted to put Bitcoin as an investment in his cash balance plan. Well, that's a really bad idea. Now, why is that a bad idea? Because a cash balance plan, there's a limit on what you can take out when you get the benefit out of the plan. So if you have an asset that's going to have runaway growth potentially, you don't want it. And the other thing, the other piece of the puzzle is the deduction for the contribution to the year. The calculation of the deductible contribution depends on the assets in the plan. So what I tell people when they ask me about investing assets, I said, if you put a cash balance plan in and you bought a lottery ticket and it won and you put it in the plan, that'd be a good thing. No, it would not. Because what would happen is you'd never be able to make another deductible contribution. Plus, because the assets were so far over what you could take out of the plan, you're going to pay a 50% excise tax on the excess assets plus ordinary income tax. So the IRS is going to end up getting 85 to 90% of the excess assets out of the plan. So the client has to understand it's got to be invested in safe assets with predictable, slow growth. Some people don't like that. So, I mean, so, so it's not for everybody, but most people have an asset allocation strategy in their head where they want certain assets invested in safe, in low yielding investments. So what you have to tell them is if you put a cash balance plan and maybe you have to move some of your outside safe assets into riskier assets, and now your cash balance plan is going to be a buildup of low, CDs, for instance. So again, this, so that's kind of what I do.
I'm gonna jump in for 1 second here, just try to speak about some concepts here. One is you've got like our attorney, 70-year-old guy that couldn't put any money into an IRA, but let's assume he puts $300,000 into a cash balance plan. He's 70 years old. When does he have to begin taking it out? Well, one of the things about a plan that, Brad and I put a couple together, where they have a 5-year vesting period where he doesn't have to take the money out until 5 years later. So there's ways to plan and do whatever you want to create if you can get the right creation with doing it. And then sometimes somebody's working in one area and then he changes a little bit. We can terminate one of the plans to move it into something else and then start up a different plan. So there's a couple of ideas there that work. One of the, I had a thought here. The same guy that's doing the Roth conversion, if in fact he makes some money here, does a Roth conversion. Why is he do the Roth conversion? Because he can use a stronger contribution into a defined cash balance plan, defined benefit plan, such that can offset some of the conversion to a Roth. One other thing about a Roth, inside the 401k plan, there's often Roth provisions. Once you spend a little,
so just a little history to set up what I'm about to say. So the cash balance plans have been around since '94. Defined benefit plans have been around since even the 40s. So these ideas are not new. But what happened in the early 2000s, the IRS cut a connection. If you were a doctor or a high-paid professional or a highly paid taxpayer who owned their own business and you sponsored a 401k plan and a cash balance or a defined benefit plan, there used to be a limit that connected the two plans. And it was so complicated that no one could ever do it right. The IRS they actually admitted, we don't even know how to do these calculations. They published the regulations and they said after a few years, they're like, we don't know how they actually are supposed to work. We're giving up on trying to explain it. So they just did away with them. So all of a sudden you could have a fully funded 401k plan and a fully funded cash balance plan. So all of a sudden cash balance plans started taking off. because you could do both kind of plans at the same time. Now, the Roth idea came into effect. And that is, the hottest, I think, what I think is the most popular and least publicized, though it's becoming more publicized, retirement ideas is super funding a Roth IRA. Okay, and how do you do that? So if you have a business, and first of all, the business owner can't have any employees in the 401k plan besides him as his wife, or I'm sorry, the owner and spouse, and maybe some children. They all have to be owners. If there's employees, the testing, what you have to give to the employees becomes very onerous. So, but if you have a business, owner-only business, owner and spouse business, or a business where everybody's an owner, like a partnership, a bunch of anesthesiologists, for instance, where everybody's an owner, all right? If you have a business like that, and you put a 401k plan in, or there's already a 401k, and maybe you have to amend it, to allow something called after-tax contributions, okay? Now, an after-tax contribution is just what it sounds like. And they've been around since the early 90s. So you make the contribution after you pay taxes on the money. Well, why would you do that? I had a buddy who did that back 100 years ago at a company I worked with. I could never understand why I did it. Well, what that meant in the old days was the growth of the assets that were due to after-tax contributions, you got your contributions out tax-free, you paid interest on the earnings, okay? However, with the Roth, when they introduced Roth IRAs, you can make an after-tax contribution to a 401k plan and roll it to your Roth IRA. So what's that mean? That means that you can, you can make in effect, you can make up to what's called the defined contribution 415 limit. That contribution can go into your 401k plan, and then the next day can be transferred to your Roth IRA. So $73,500 in 2023 can be moved from a 401k into a 401k plan and then back out to a Roth IRA. Now, why do you want to do it in one day? You want to do it in one day because you don't want any investment earnings on those assets inside that 401k, because that can't come out, and you'll pay taxes on it when it eventually gets distributed. Okay. And that's the only, that's what I do personally. I put money into my 401k and then I move it into my Roth IRA the next day. So that idea, and it's still, I mean, if you look on YouTube, Superfund or Roth IRA, you can find a bunch of people getting very excited about which I think is great, because it's an idea that it's just fantastic. I mean, think about it. The 401k limit or the limit on deferrals to a Roth 401k is 30,000 if you're over 50. So you can put over twice that much, and you can get it in a Roth IRA, which right now is not reported to the IRS. Right, the 401k plan is you've got a tax filing required, a 5500 EZ. So to me, that's one of the kind of up and coming retirement strategies that everyone should be recommending to their clients. I mean, if the client has the right situation, right?
Where does the 73,450 come in?
Well, so there's a limit that gets published every year by the IRS that is called the defined contribution 415 limit. Okay. So basically to take advantage of that, typically, so there's two pieces here. So if you wanted to, so let's say if you were the owner of a company and you just wanted to make a profit sharing contribution, all right, and you were going to make it up to the defined the 415 limit is the most money that can go into a 401k plan for a plan participant in a plan year, all right. So just to make the math easy, let's say it was it's bigger than that. Let's say it was $60,000. You would have to have a W-2 of $240,000 because it's 25%. So in other words, the limit is the lesser of 25% of your pay, or 60,000 bucks in my example, right? So again, in my example, actually, so you were allowed, you can make that whole amount of money, you can say that's an after-tax contribution. So that's where that so the 73,500, actually, the way you get there is the DC limit in 2023 is $66,000, okay? So you actually get, if you're over 50, you actually get to add the catch-up contribution to the $66,000. So the catch-up 7,500 for 2023 for a 401k plan. So you get the 66 plus the 7,500, which is the 73,500. So just to really tidy that up, what you would actually be doing is you would be making a Roth 401k deferral with a catch-up plus an after-tax profit sharing contribution to make up the difference. They would go into your 401k, and then the whole thing, if the plan would have to allow it, but that's just a checkbox on the form, then the plan would allow both of those buckets to get rolled to a Roth IRA.
Is that every year?
Every year. Every year. So just think about the potential to build up tax-free income in the future. I mean, I'm trying to tell my kids, put your money in Roth 401k. Do not make 401k deferral. Dad, I want to pay taxes yet, but you're going to love this. Make those Roth deferrals now. And the other thing is that if you have a side business, if you have 1099 income, all of that is eligible. So the other great thing about this after-tax deferral, this after-tax contribution idea, is it doesn't take into account if you're contributing to another 401k plan. So for instance, let's take our hypothetical doctor again, right? And he's working at a hospital and he's maxing out his 401k. If he's got a side practice, he can't make 401k contribution, pre-tax or Roth, because he's already used it all up at the hospital. But it doesn't affect his after-tax ability at all, right? It doesn't. That's in the code. So in other words, he can fully defer here in the hospital, and he can still put, in this case, he wouldn't get the advantage of the catch-up, right? Because he can't make a 401k deferral, but he could put $66,000 into an after-tax 401k plan for a sole proprietorship and get it into a Roth IRA. I mean, it's the greatest. And the other thing is, for the last 2 years, people in Congress have made noises about getting rid of this ability. There are people who are like, why did we let that happen? We're going to get rid of this. But, every year, I think that there are people on both sides of the aisle, people contributing to those Congress folks, that on the sly, they say, don't get rid of that because we like that. Whether Democrats or Republicans, they like being able to do that. But you never know. So that's why people ought to take advantage of while it's available, because it's just a great retirement savings opportunity right now.
Just so all of you know, Roth IRA, you put money in a regular Roth IRA. I don't know what the max is on a regular Roth IRA.
7,500.
Yeah, so it's like nothing compared to what you could put in. The other point is you have to leave it in there for 5 years, and if you leave it in for 5 years, that is just absolutely free money because there's no tax on it ever. There will be an inheritance tax on it. But that'll be about it. If you move to Florida and take it all with you down there, you don't have to worry about that. Somebody's moving to Florida in the class here. I don't know. So you heard it first here. But in any event, that's significant. On the $66,000, though, it's not like a say, 73.5. It's not a straight 73.5. You will have to pay tax on that 73.5. So whatever.
That's true.
So
Right.
that's the only catch, if you will. And so we talked a fair amount about conversions into Roth. Well, here he's every year he's converting into Roth, which is, well, he's paying tax on it yearly. It's not as much of a burden, but it's, you know, let's say it's $12,000 of income tax he has to pay on it, and then it's done. So it's fantastic.
On the handout here, it says that, about a compressed time frame for an inherited Roth IRA for withdrawing from it. It's on page, it's 2 pages before or it's 1 page before the tax update current issues. The IRA conversions Roth IRA. This page here. It doesn't mention the inheritance tax.
Oh. Let's see what we got here. IRA conversions to Roth. The inheritance tax, the Roth would be subject to inheritance tax.
Oh, I'm sorry.
Hearing something.
Yeah, it's behind you. It'll go off in a minute.
So they're calling her Roth conversion guy. I can't find exactly where it is, but I'll come up with some sort of.
You can just call it mine.
No, that's, I think this is.
It's just like-
Yeah, what this boils down to is that you have 5 years on a Roth IRA compression as opposed to a 10-year thing. That's what I looked at. And the 10-year on an inherited amount. Are you following me there? In other
Yeah,
words,
but what's the inheritance tax? It doesn't mention.
so it's not inheritance tax. It's the inherited withdrawal. You have to have 10 years. You have to withdraw within 10 years. That's what that means. You can withdraw it from a Roth faster.
So there is no inheritance tax on a Roth that you get.
No, there is inheritance. It's the difference between it is if you inherit qualified money, $100,000, and you have to take it out over 10 years, so you have to pay inheritance tax on $100,000, and you have to pay income tax on the withdrawal. And that's over time, and you would spread that over 10 years because that would be the lower taxes you're paying that they, you know, if you
Okay,
make
so
$100,000.
if I leave my son $100,000 in a Roth IRA, because my Roth IRA, he's the only beneficiary.
Correct.
He's gonna pay
Inheritance tax is $4,500, the same thing you pay on the qualified money. But on the income, what your advisor will tell you, how much you pay, get $10,000 a year for 10 years because your tax bracket is something lower. Where on a Roth IRA, you can take it out and whenever you want it and go to, you know, I always say that, you know, your son's gonna go to Atlantic City and gamble it away first year, so don't do that.
Okay, thanks.
So, does that make sense now?
Yeah, I appreciate that.
So have we got time to talk about this real quick?
Yes, absolutely.
Okay, so to switch gears,
This is
there's,
important also.
yeah,
This is
there's
big time.
a handout, new long-term part-time employees proposed regs. So when Congress passed the first Secure Act, which I think is 4 years ago now, they also included, well, their Secure Act it was massive, and it had provisions about retirement plans and other things as well, but there was some language in there that said that Congress wanted to allow long-term part-time employees they wanted to ensure the long-term part-time employees were able to participate in 401k plans, okay? So prior to 2024, 401k plan sponsors could if they drafted their plans to be the biggest hurdle to getting into the plan, you had to be working for a year and you had to work at least 1,000 hours, and you could come into the plan January 1st or July 1st following the anniversary of your hire. All right. So that meant that if you were moving in and out of employment, you might not actually enter or have the ability to defer money into a company 401k plan. So these laws were passed, but of course, they didn't actually tell anybody how they were actually going to be implemented. So the IRS has been sitting on these things for 4 years. These regs were dropped Thanksgiving Day. They're effective 1/1/2024, and they are huge changes to the 401k landscape. And it's going to be a big deal on every company that sponsors a 401k plan of any size, because all of a sudden, you know, in other words, you had to track, it was like if once you hit 1,000 hours, you could flag that employee. And then once they hit their, year of hire, then you could wait to the January 1st. So people came into the plan, it was fairly predictable. Now you have to look back, and anyone who's worked 500 hours or more for any of the 3 prior years, or for 3 prior years, they're going to enter the plan in 2024. Okay, so that's the first kind of added complexity. The second is, if the participant enters the plan because of this change in eligibility, they are going to vest. In other words, vesting is how quickly they get access to the company's money that's put into the plan by the company. They are going to vest based on the 500-hour rule, not that most plans use 1,000 hours. So not only are you going to have this added complexity, who's going to be a participant in the plan, which means when someone becomes a participant, you've got to give them a handout about the plan. You've got to explain to them how they're going to sign up. How are they going to decide to make salary deferrals? What are the, maybe there's a website they have to go onto, things like that. Now you're going to track their vesting based on 500 hours, and that's irrelevant. The IRS, they could have done this a lot of different ways. What they said is, if you get into the plan based on that rule, you are always going to vest based on 500 hours, even if you become a full-time employee, and full-time employees vest, say, on 1,000 hours. So now the 401k plan sponsors have to track 2 different types of vesting. So if someone comes in as a long-term part-time employee, their vesting is going to be calculated differently than someone who is hired from day one as a full-time employee. So these rules are just, and they're, so just those 2 small changes cascade down through it makes changes to safe harbor plan operation. It makes changes to, like those examples where I was showing testing, even though those kind of tests don't operate on big companies still do ADP and ACP testing. It's going to change those testings, the way those tests work. I mean, it's just, and the retirement communities had a month and a week to basically look at these regs and try to figure out how they're going to implement them. So if you have a client that has a 401k plan of more than owner and spouse, there's going to be changes in how that plan operates. Now, what I would say is the retirement practitioner community is pushing hard with the IRS to delay the implementation till 1/1/2025. And there are a couple of there are some things in the new regs that are delayed, but the vesting and the adding the long-term part-time employees is not delayed right now. And I don't know, because we're so close, what the chances of this being, I'd say they're not great, but this is how the IRS knows that they're sticking their thumb in the eyes of the people sponsoring these plans. They said, you have to operate the plan. Here are the rules that you got to operate under. But we're going to give you a year to amend your plan to codify how you're operating your plan. So, hey, that's great, but no, that's not great, because what that means is you're going to operate your plan without a plan document telling exactly how it's going to operate. So you have to decide in the next month operationally how you're going to make this thing work, and then make sure that at the end of the year or before the end of the year, you write that into your plan document. I mean, it's a freaking mess. It's a freaking mess.
I'm gonna give you two examples, my example of these 500-hour employees. But first off, here's this thing that his sheet that he put out here. Let's assume that he has a 20-year-old and a 68-year-old that puts in 500 hours. They both are caddy on the guy, doctor's golf course that's in the back in his waiting room. Okay, and these two guys, both of them have 500 hours. That's going to screw up his whole page here as to how he's going to have to make his assertion, especially the 80-year-old's going to have more money put in and his age, so somebody's age waiting pack. So that's all going to complicate that. And here's the complication with anybody in HR. And one of my clients had a tugboat company. And the tugboat companies would get employees, and so what would happen, they pull into the tugboat on Monday, and they needed 20 or 10 guys on their tugboat. So who did they get that's going to go on a tugboat for 2 weeks and hang on the tugboat on the river? Criminals. People that were criminals that were on parole, they'd be out there, they'd walk in, and wow, we're here. Okay, so they go on the boat for 2 weeks. Then the next, when their shift comes up 2 weeks later, they're not there. So the issue with getting whether or not these people had 1,000 hours and they had shoemaker payroll, and then they would give it to me at the end of the year. Oh, here's our, we have to do our tax return for our profit sharing plan. And it only costs about $80,000 for me to figure out who had 1,000 hours. I'm being, facetious here a little bit, but it was very difficult. Now you've got 500 people that these same criminals, if they get 500 hours for the last 3 years, it is a massive mess. And if it's vesting, now it would seem to me that every plan's going to change, so they'll all have 500 hours vesting. I bet that will happen.
Yeah, I
They
mean,
won't
so-
be able to manage it.
So one of the recommendations that people have come up with is that if you amend your plan to just let everyone in at a lower threshold that would meet the long-term part-time employee threshold, then your problem's solved, right? Well, your problem's solved on the administrative complexity side, but it might not be solved on the cost issue, right? Because you might, depending on your workforce, you might be letting in all kinds of employees that you didn't have before. Well, is that an issue? Well, I mean, the one issue is raised at the bottom of that page. Paying for an audit of a qualified plan is an expensive proposition, a very expensive proposition. And that the plans have to be audited by a CPA firm or a CPA if they have over 100 participants. Well, if you have a lot of these LPTL people and you say, okay, we're just going to not worry about that, but we're just going to say everybody come into the plan, maybe you had 80, now you have 130. Now you're paying for an audit, right? I mean, and so, and the audit issue is a DOL issue. And the DOL has been mum about whether they're going to, my guess is they're going to say, no, there's 100 folks, whether they're let in by LPTL rules or, the regular eligibility. If you got over 100, you got to pay for an audit. So for the really big companies, they're already paying for an audit. That's not that big a deal, but for a lot of companies that are right around the audit size, that's a big expense. And paying a CPA to audit your plan it's a lot of companies, when they hit that threshold and they have to pay for an audit, they're like, we need to shut this plan off. This is freaking ridiculous.
Just to try to tidy up what we are, because I have a few minutes, I want to go over a couple things. one of the things about, I was talking about the attorney that, there was one attorney that's making over $1 million this year on it's another case with a referral, and he's gonna get like 300,000 in. One of the big selling points for me telling this attorney, here's why you wanna do this, and he's, hasn't made much money throughout his life, so he's a little scared. And I said, the big thing about this, as attorneys, you're always subject to malpractice. If you put your money in a qualified retirement plan, nobody can get it. And because I've litigated, because there's the anti-alienation provision, I don't know if you ever heard of that, but I tried to litigate and get money out. It's a long story. Two partners fighting each other, and one guy put all his money in a qualified retirement plan, and he owed the other partner money. And I said, he's the only guy that has that. He puts money in one pocket, he takes it out and put it in the others, and now we can't get it. So I sued and tried to get the IRS on my side to get him to remove his money. Wouldn't do it. So once it's in a plan, that $300,000, you're talking about getting money into a plan, it's there for good. I think the same protections on a Roth too.
It is, and actually, so the example I use, which people are getting farther and farther away from this, is O.J. Simpson. O.J. Simpson lost almost everything, but he did not lose his NFL pension, because like Fred said, that's not touchable. You can't sue to get that money. Now, he might have lost it, maybe they were able to attach it after it came out, but they can't get that money. So for practices, for professionals who pay large malpractice E&O premiums, getting money into a qualified plan is a way to keep it safe.
Yep.
All right.
I think I have one more comment, but I forgot it. Okay. So, anything else with Jeff? Any comments there?
We've done some of these kind of things worked a little bit too. Okay, here I have the Sunset Tax Cut and Jobs Act, and after that, I have IRS tax update current issues. One of the things that the IRS is trying to do is increase enforcement, and they're increasing enforcement with foreign penalties. They're trying to, and FBAR overview. They are also, if you make gifts, like there was a Coca-Cola company in I think they bought a Coca-Cola, maybe some other pop, and it was a pretty big operation. So in this is an older case, 1989, they made gifts of 10% of the stock of this company to their kids. Maybe 4 kids, they all gave them 10% of the stock. And they had valuation experts come in and value it at, we gave them 10 million. At that time, the gift tax was lower. So they paid a gift tax on, let's say 9 million of the 10 million. Okay, they would have paid 4,500,000. They audited them within 3 years, and then 5 years later went to court. So that's like 10 years later, let's say. And at that time, they said the valuation way back when they made the gift was wrong. Instead of it being 10 million, it was worth 20. So then they owed additional tax on that gift, if you're following me there. So that is one of the ways. And there was a case not too long ago, and the IRS has slimmed down, but right now they had 7 attorneys representing the IRS in this gift case that just happened this year. So there's that increased activity with really wealthy gifts. Okay, one last thing there, passport revocation. If you owe money to the IRS, they take your passports, or can take your passport. I just got a passport back for a client of mine because I had him make his current taxes, and then I put all the rest of his stuff, and it has to be a valid offer and compromise, but I was able to put it in an offer and compromise. When you have a client, I have a client that owes, oh gosh, $1.5 million in unpaid payroll taxes. And they've had this business and they've just never been able to pay. And it's been from, I don't know, for the last 20 years, they have a buildup of this. And so they've been on a payment plan forever because they fix, repair trucks, body shop. So anyhow, what I'm able to do is make an offer in compromise. When it's an offer in compromise, it's valid. You got to make sure it's valid. All collection activities stop if they're current. And if they're current and you have an offer in there, they can get their passport back, which is what I did with this one group. So that's one more way they're making enforcements. And the last thing I have with a few minutes left is advanced estate planning, generation skipping tax trust, where you have $1 million, you only have $1 million exemption for generation skipping tax. And if you have, if you put money into a trust, a regular trust, you don't allocate the $1 million for the generation skipping tax, and it goes to the sons, and then 10 years later, it goes to the grandkids out of that same trust pool that wasn't allocated the generation skipping tax. 10 years later, you have to pay the generation skipping tax. You follow me there? That's a big deal. So you have to properly plan for a generation skipping trust. GRATs are really good. I don't know if anybody's a zeroed out GRAT. Means that you can give mom and pop on 50% of the company. They put all their, and they each have 50% of the shares, 500 shares each. They put 500 shares into a grant or retained annuity trust that's valued at, let's say, 20 million bucks, $10 million for each one. They have to have an annuity that pays them $10 million back. Let's say these shares in there, when they put in each of the all the shares, the 500 shares were worth the reciprocal amount, let's say $10 million. During the time that the stock is in the trust, that same stock, instead of being $10 million, is now worth 15. They get the money, the $10 million back, plus interest at a rate of the applicable federal rate, 3%, 5%. What remains in the trust, it's like an insurance. If you buy an annuity from an insurance company, you give them 10 million bucks, that insurance company makes, say, $3 million on it. They give 1 million back, the insurance company keeps the 2 million. But if the owners of the insurance company are your kids, they keep the money. It's a zero gift to the GRAT. So something else to think about. Dynasty trust is literally a trust made up of life estates for your kids. Then it goes to life estates to their grandkids. So that's how a dynasty trust works. Charitable remainder trust. You can put something in a charitable remainder trust where it pays you, pays the owner back some money, charitable. Family LLC is the same thing with the GRAT. That's one of the ways I use the GRAT to do that. Irrevocable life insurance trust. If you have a client that has potentially a very large, I have a guy that's a doctor, he's going to have an $80 million estate, bought an insurance policy. You make the premiums to the trust, then the trust pays the premiums. So the trust then owns, the irrevocable trust owns the insurance policy. When the guy dies, the beneficiaries are the kids. Essentially, it's tax-free because it's not in the guy's estate, and then you use that money to pay his estate tax. So there's a couple, I just want to hit a couple things here, and I think it's about time for us to go. Anybody have any questions? Okay, perfect. So, but I hope you enjoy this. We enjoy putting it on because it makes us work a little bit harder at the end of the year and to keep us up to speed on what's going on, because you oftentimes you end up teaching some of these COEs, and there's somebody in the back that's reading a newspaper. In my old days, I would always go back and pick on that guy and see what's in the funny pages, but it's good for somebody to keep working, and you learn more when you have to get up here and say it. So anything, comments, questions? Thank you.